to.
All right. Let's go from the seed stage all the way north to the public world to talk about a company that got punched in the face this week, which is Grubhub. For those of you who are young, Grubhub is the kind of the original place where you would go online and order food and have it delivered to your house. You didn't have to leave, or at least the first like online version that really hit massive scale in my experience. These days, it's being challenged by DoorDash and Uber Eats and Postmates and companies like that. It had one of the worst weeks it's ever had this week. And the problem was that it reported earnings and immediately lost about 40% of its value. And a number of very large banks, analysts, departments slashed their ratings from buy all the way to sell and dramatically curtailed their share price targets because the company missed expectations and forecasted very slim growth. And Kate, if you're a public company and you do those things, your value collapses, more or less. Now, I bring all this up because they had an investor letter that was, at least from their own perspective, very honest. You can disagree with what they said. Some people have reached out to me after I've written about this and said, they're wrong, fair enough. But Grubhub outlined some issues with the market. They discussed, without naming them, competitors like DoorDash that have a lot of money. They talked about the expanding world of food delivery and kind of the on-demand space. And essentially what they've said is the pace of growth of food delivery on demand is going to slow. That this era of insane growth and that is kind of come to an end, and we're going to see much more moderate expansion in the market. And Kate, my read of this, kind of bringing this story back to our world that we talk about, it could imply that companies that are highly valued right now, DoorDash, Postmates, et cetera, that are valued on growth could see their natural growth diminish. And I'm curious if that could put them under pressure. The other side of this argument, of course, is that, Grubhub could be inept and, DoorDash very, very savvy. But, it struck me as reasonable that the natural growth would have kind of run its course by now. But I'm curious what you think, hearing all that kind of in one big paragraph.
So is what you're saying, you think that given all the information you just went over, Grubhub was overvalued, and so then will they see a big slash in their market cap? Or what are you saying you think will happen?
Well, I'm just curious if the declining growth that Grubhub is seeing can be correlated to the private companies that are challenging it for its market dominance. And if what we're seeing from the public markets will trickle backwards into the private markets, will DoorDash endure a slower growth rate? And then if it does, does that really mess up its valuation, which is high and predicated on relatively quick growth?
I think certainly all the on-demand companies have and will, maybe won't continue to be, but have historically been overvalued. So yes, I think that anything that happens to Grubhub, which is a leader in the category and one of the companies that is public versus a lot of its competitors that are still private, it will have a really big impact on them. And I think, don't you see some parallels to WeWork, which was valued like a technology company despite being actually a real estate company, and now their valuation has been brought back to reality, and is what, $8 billion versus $47 billion?
Well, it's an $8 billion set by one of its prior investors.
Set by whatever arbitrary metrics they use. And then when you look at these on-demand delivery companies, similarly, this was an era in which companies were valued very highly because it was a really innovative time when we sort of birthed the demand economy. And so I think because of that, the companies born during that time have really benefited. I think Postmates is slightly different. They have a lower valuation. It's higher now. I think it's 2.3, something like that.
That sounds about right. Yeah.
Yeah. So it's lower, but I think, I talked with the CEO of Postmates at Disrupt, and he even said that like they, at times would have liked a higher valuation and didn't really have the ability to get it with all the competition in the space. But DoorDash is worth a ton of money, backed by SoftBank, right?
$12.6 billion after their last $600 million round, I think, Kate. So a lot of money.
So yeah, so why did this story catch your attention initially, Alex? Get you to write this post.
We always look at private companies. That's kind of what you and I do.
Yeah.
And the downside is private companies don't report earnings. They don't tell us much. They don't tell us their gross margins. They don't tell us their GAAP net income. And so we're constantly scraping on the edges with like funding rounds, some revenue growth numbers, some comps. It's hard. It's hard to tell what's going on. So when Grubhub describes the on-demand food market, which is a key part of like Uber's business and Postmates and all these other companies, and says it's going to slow down dramatically, I sit up and go, oh, that might actually impact these companies we do care about. Anyways, we've probably gone on too long about this, but if you have time over the weekend and you're feeling very nerdy, I would recommend going to Grubhub's investor relations page, dig up the shareholder letter and give it a read. It's an interesting document if you care about money and companies in general. And it might help you understand the impending IPOs of DoorDash and Postmates, which have to happen eventually.
Yeah, and my final thought too is just that you do a really great job of following the public markets and earnings. I do less of a good job because I'm so much more interested in like companies that are worth nothing and just building. But the public markets, and this is extremely obvious, but just have a huge impact on startups and trends and how companies are valued. So we should all pay attention to that. It's a good way to sort of predict what's coming.
Yeah, the best way this was ever phrased to me was, I think, by Jason Limkin. He's told me once that the startup market is just the NASDAQ on steroids. So you can kind of like figure out what that means for startups pretty easily.
That's true.
Okay, let's talk about